Welcome for another look at the charts. With the release of the US employment report for June due out tomorrow, we take a look at how some major FX pairs are moving. Starting with EURUSDs for our chart, EURUSD continued its drop by breaking the 1.1885 support line, now turned to resistance. We tend to maintain a bearish outlook for the pair as long as the downward trend line guiding it remains on top of its price action. Please note that the RSI indicator below our 4-hour chart bounced on the reading of 30, implying that the pair may have reached an oversold level and corrected a bit higher. Please note that the pair is currently at an almost 2-month low level. Should the bears actually remain in charge of the pair's direction, we may see it breaking the 1.1785 support line and aim for the 1.1695 level, which reversed the pair's downward movement on the 15th of October last year. Lower, we note the 1.1605 barrier, which has not seen any price action since the 4th of November last year. Should buyers be in control of the pair's price action, we may see EURUSD breaking the pre-mentioned downward trend line, the 1.1885 resistance line, and aim for the 1.1995 level, while even higher we have noted the 1.2095 hurdle. On the common currencies fundamentals, we note the path of the pandemic in Europe, which for the time being seems contained, yet should the Delta variant of COVID-19 make its presence felt, we may see the euro depreciating. Moving to GBPUSD for our chart, GBPUSD also maintained some bearish tendencies as it broke the 1.3845 support line, now turned to resistance. Also in this case, we maintain a bearish outlook as long as cable remains under the downward trend line incepted since the 23rd of June. Please note that the RSI indicator below our 4-hour chart is just above the reading of 30, confirming the dominance of the bears, yet at the same time warning that the pair is nearing oversold levels. Also, please note how cable's price action slides on the lower boundary of the Bollinger Bands, also implying that a correction higher could be in the cards for the pair. Please bear in mind that the pair has not reached such low levels since mid-April. Should the selling interest of the market for the pair be extended, we may see GBPUSD breaking the 1.3670 support line, aiming for the 1.3525 support level, which has not seen any price action since the 18th of January, while even lower, we note the 1.3350 support level. On the flip side, should the bulls take over, we may see GBPUSD breaking the pre-mentioned downward trend line and then the 1.3845 resistance line, aiming for the 1.3990 resistance level, which contained the pair's upward movement on the 23rd of June and the current downward trend began. Even higher, we note the 1.4145 resistance level, which troubled pound traders from mid-May to mid-June. Pound traders should keep an eye out for UK's GDP rates for May on the 9th of July, yet before that the nationwide house prices is due out on the 7th of July as well. Next will be USDJPY for our chart. USDJPY jumped yesterday, breaking the 110.95 resistance line, now turned to support, breaking the upper line of the symmetrical triangle which encapsulated its price action, and continued higher, aiming for the 111.70 resistance line during today's Asian session. We tend to maintain a rather bullish outlook for the pair. The RSI indicator below our 4-hour chart is fast approaching the reading of 70, with an upward slope underscoring the pair's bullish tendencies. It should be noted that the pair has reached levels so high that have not been seen for over a year now. Should the bulls actually remain in charge, we may see USDJPY breaking the 111.70 resistance line, which capped the pair's upward movement on the 25th of March 2020, and aim for the 112.25 level, which reversed the pair's ascent on the 20th of February 2020. As our highest level, we note the 113.10 resistance line. Should the bears take over, we may see the pair breaking the 110.95 support line and aim for the 109.95 level, and even lower we highlight the 109.25 line, which held its ground against the pair's downward pressure from the 7th to the 11th of June. Fundamentally, we expect the yen to remain driven mainly by safe haven flows in the coming week, mostly due to the spreading of the pandemic. And last but not least, we see USDCAD for our chart. USDCAD seems to have stabilized as its price action revolves around the 1.24 level. We tend to maintain a bias for a sideways motion given that the pair has broken the upward trend line guiding it since the 28th of June. On the other hand, the RSI indicator below our 4-hour chart is above the reading of 50, implying that the bulls may have a slight advantage. Also, we note the upward divergence of the 100 moving average in comparison to the 200 moving average, which also tends to imply a steepening of the pair's upward slope in the past days, yet we highlight the fact that moving averages are followers rather than leaders in technical analysis. Should the pair find fresh buying orders along its path, we may see the pair breaking the 1.2470 resistance line, which capped the pair's upward movement on the 21st of June, and take aim for the 1.2560 level, while even higher we note the 1.2635 line, which has proven its worth consecutively on the 30th of March, the 7th of April, and the 21st of April, the last time it saw any price action. Should a selling interest be displayed by the market for the pair, we may see USDCAD breaking the 1.24 support line and aim for the 1.2320 level. Even lower than that, we note the 1.2230 barrier. CAD traders should keep an eye out for Canada's employment data on the 9th of July, as well as oil prices, as they can affect Looney's direction both ways. Finally, closing with the USD, as we have mentioned, the US employment report for June is due out tomorrow, the 2nd of July, and could affect the greenback's direction. Traders are looking to the US non-farm payrolls report for signs on whether the US employment market is tightening or not, and recent polls by Reuters expect a gain of 700,000 jobs created last month, and the unemployment rate to tick down to 5.7%. On the other hand, safe haven assets such as treasuries, the greenback, and the yen seem to remain in demand given the fast spreading of Delta variant of COVID-19, which could slow down the economic recovery on a global level. Countries such as Indonesia, Malaysia, Thailand, and Australia are reported to be struggling with the pandemic, while a number of European countries have announced quarantine measures for British subjects. So we would note the possibility that the greenback could enjoy some safe haven inflows in the coming days. Thank you very much for your time and focus. We appreciate your participation, and if you like this video, please feel free to share and subscribe. Please note, as an effort to support traders on as many fronts as possible, we are now presenting live weekly webinars on trending subjects, and all our subscribers are welcome to participate. From everyone here at IronFX, best wishes for solid trading.